Okay, here we're going to talk about cash flow, particularly the cash flow that we're going to use in calculations later in this course. So the cash flow that we calculate, or we talk about calculating here, will be used when we start doing net present value calculations to decide our capital investment decisions, should we build a factory, and so forth. So that's the cash flow we're talking about here, where I am not going over the statement of cash flows, which is a financial statement. We don't use that. So the idea here, I alluded to when we talked about the income statement, is we basically take the income statement and we reverse the non-cash deductions to give us cash flow, right? So the idea here, the big definition that we're going to use often in this course is operating cash flow is EBIT plus depreciation minus taxes, right? And I have a bunch of online, so in the actual calculations you can try to practice problems online, but it's a simple calculation, right? So we just take EBIT, which we have here, we add back in depreciation, we subtract taxes. So the idea of this is a non-cash deduction, so we don't want to subtract it from EBIT, right? Because that does not represent a cash outflow. So we add that back in. Taxes is a cash outflow, so we do want to subtract that. So we get EBIT plus depreciation minus taxes. The only difference here is we do not, note that I'm leaving out interest. We do not deduct interest here. Interest is a cash outflow. However, there's an important principle to bring up now, and that's the separation of the financing and the operating component. So the idea here is, if we were to deduct interest, then that says how my particular that allows how my particular choice in financing to affect the cash flow, right? Which again wouldn't be operating, right? This is just cash flow from operating the assets. So this is, again, this will show up throughout the course, but the idea here is the financing and the operating decisions are independent, right? And this is also important because, again, the operating financing I can change at any time, right? We might have a set of assets and I finance it a different way than you finance it, but that doesn't mean that it's throwing off different amounts of cash flow. Operating those assets should always throw off, same set of cash flows. And then just, we don't want my particular choice in how I financed it between debt and equity to affect those cash flows. So again, we only want to know about cash flows from operating those assets. We don't want to let the financing decision affect that. And that'll show up later when we talk about capital structure, the Modigliani and Miller theorems, where we say, the financing decision is irrelevant. And if I haven't mentioned it also, financing you can change really quickly. So the idea here is, it's much harder to change the cash flow. I could operate that more efficiently. I could operate the assets more efficiently to get more cash flow. That is hard. But if you let me have my financing affect the cash flow, well, financing is very easy to change. I can change my capital structure much more easily than I can change operational efficiency, right? So, long story short, never deduct interest, right? Good. So this is what we're going to generally use, operating cash flow. This is more important. If you're watching this video and you're not in my class, then your instructor, your professor may put more weight on the actual calculation of cash flow from assets. I'm going to talk about it briefly, give you an overview, tell you what's important to know, what's not important to know. But we can say, okay, this is our cash flow from operating the assets, operating cash flow. Then our total cash flow from assets is usually defined as operating cash flow minus the change in net working capital minus capital expenditure, right? Capital expenditure, this would be, if you actually want to calculate this, this is going to be like ending fixed assets minus beginning fixed assets plus depreciation, right? Change in net working capital is just the ending minus beginning net working capital. So the idea here is, what this is saying is I have to buy more machinery, right? So I may, my assets may generate this cash flow, but I may use some other cash flow to buy new machinery. I may use some of that cash flow to maybe increase my sales on credit relative to my receivables. So that's fine. And often this might be turned out, I'll go ahead and mention, by definition, this also, cash flow from assets equals this, which also equals cash flows to creditors and cash flows to stockholders. This is, again, an identity. Any cash generated by our assets can only go two places. We're management, we operate these assets, generate cash, that cash goes to shareholders, it goes to debt holders, it can't go anywhere else. Again, we pay off debt holders, and then whatever's left goes to shareholders. Good. So, and I don't want to bog us down in the calculations of these things, but one important point about this that I want to make, and this is important for you going to work somewhere. Sometimes this will be called free cash flow. You might hear the term free cash flow. One thing to note is the actual calculation of free cash flow will differ from industry to industry. So this is kind of a broad look at free cash flow. But if you go in and work at a movie production company, or you go into work at an oil E&P business, they might calculate, given the nature of their business, free cash flow a little differently. But loosely speaking, this is what we sort of mean by free cash flow. I generate a bunch of cash from operating, I need to buy new equipment and maybe more accounts receivable, so whatever I have left over is free cash flow. Right? So, good, and then free cash flow goes to creditors or stockholders. But I really want, I would never go work for a company and go, well, that's not how my tax calculated free cash flow, right? Because every business is a little bit different, and you just want to know from this course the principles of what we mean. This cash flow is unencumbered by capital expenditure or working capital requirements. However, the most important thing we're going to use here going forward is operating cash flow, OCF. We'll call this OCF from now on. And again, this is this should be just you don't have to memorize anything, but that should be you should know that because we're going to use that quite a bit in the future. Excellent.